So salary sacrifice is another strategy, and it provides a significant amount of benefit in terms of tax savings that can then turn into basically more money in your pocket or superannuation to boost your retirement savings. Now let's look at how that works. So salary sacrifice, if you're not salary sacrificing, what your employer does is before they give you the money or pay the money into your account or your earnings into your account, they deduct some tax from it, so withholding tax at specified rates. Once they've deducted that tax, then they'll put the remaining amount of your salary into your bank account. Then you can use that money from your bank account to spend, you might save some, and you might choose to put some money into your own superannuation fund as well. That might be to access the government co-contribution. In the salary sacrifice example, rather than your employer deducting tax straight away, your employer is putting some money into your super fund prior to deducting tax. Your super fund deducts some contribution tax at 15%, but this is generally less than the tax rate that you'll pay up here. Once they've deducted that amount, then because your taxable income is less, your employer deducts less tax, and then the remaining amount goes into your bank account, and you can then spend and save the remaining amount. You may also want to put some money into your super fund to access the government co-contribution, similar to up here, but often salary sacrifice can provide a greater benefit. So the benefit of it is the difference between the combination of the contributions tax you pay here and the income tax that you pay here being less than the tax that you pay here, and that difference, the difference between this plus this less this, is the benefit of salary sacrifice. Now let's look at it in terms of numbers. So basically you're foregoing your income and you're directing it to your super fund instead of taking that money into your employment income into your bank account. Now let's look at Ben, for example. Now he's 59 years of age, so his contribution limit is $50,000. And so if he's earning $67,000, his taxable income is $67,000, he could salary sacrifice $30,000 into his super fund, assuming that he's got the cash flow to do so. The benefit to him is his marginal tax rate plus his Medicare levy less the contributions limit times the salary sacrifice amount. So 30% marginal tax rate, 1.5% Medicare levy, less the 15% contributions tax times $30,000. So his net benefit is nearly $5,000 per annum for making those salary sacrifice contributions. If he was in the earning over $80,000, or he was earning over $180,000, then there is a greater benefit for salary sacrificing the same amount. So the higher your taxable income, the greater the benefit of salary sacrifice. Just look at a quick example where Joe and Mary, so Joe is earning $120,000 and Mary $40,000. Their combined tax with no salary sacrifice is $39,200. If they salary sacrifice, so Joe's going to salary sacrifice the maximum amount of $39,200, Mary's going to salary sacrifice $10,000. Even when you combine or include the contributions tax, the net tax saving is just over $10,000 for Ben and Mary by making those salary sacrifice contributions.